Right. Running a bit late today, so apparently this is the second time I have to record this because the first time I forgot to share my screen. That's completely messed my plans up a bit. Anyways, so back we are again for the fifth episode of my eight-episode podcast list and trying to get my peers financially educated in what's available to them to be able to invest as per their own priorities or ideas, so to speak. I think today we're going to cover one of the most important aspects of investing because this thing literally rules, your retirement, your current investing portfolio, and so on and so forth. This thing is one of the most important concepts that I want to put across to people, and it's about index funds. But before we proceed, I just want to put across the basic disclaimers. This is not financial advice. It's only my opinion, and it's for educational purposes only to get the ideas and points across to you so that you can make your own financial decisions based on so you can make educated decisions based on your own financial circumstance. Content is being recorded, my screen is being shared, and of course so my voice is being recorded so that I can publish to YouTube for people to reference at a later time. I'm going to start today by actually looking back at last week's stuff, which is basically trying to summarize the popular indexes that are out there. You've got several options from FTSE, and you've got the FTSE 100, FTSE 250. You've got the S&P 500. You got the Dow Jones, the Nasdaq Composite, and the Nikkei. Uh, Something I forgot to put across last week is that you can't. I mean, something I did put across several times last week, to be honest, was that you can't invest in indexes. You can only invest in funds that track these indexes. What do I mean by that? The fund providing companies and the index providing companies are two different, separate entities. So, the S&P 500 is issued or published by a company called Standard and Poor's. That's what the S&P actually stands for. And if you've seen the movie The Big Short, this company is referenced where Steve Carell and his colleague are sitting next to this googly-eyed woman. That woman was actually the representative, or the desk of Standard and Poor's for all intents and purposes in that particular scene. So the S&P is one of the big rating agencies in the US. FTSE is quite a similar competitor in the UK or in Europe. They've got FTSE, the full form of FTSE is, I think, the Financial Times Stock Exchange Index. That's what the FTSE index is. FTSE Russell is, I think, a combination of two companies or two index companies that came together to merge, or I don't know what the past history is, but that's what they are. And they provide the FTSE 100, which tracks the 100 biggest companies in the UK. You've got the FTSE 250, FTSE 350, All Share, and so on and so forth. They've got probably 50, 100 different indexes that they provide. However, you can't directly invest with FTSE or with Standard& and Poor's. They just provide the benchmark. What you need to do is you need to find funds that track these indexes as best as they can. So you got the FTSE Developed Europe, FTSE Developed Europe X UK, um, FTSE All World, you know, um, that's active. Never mind. You got the FTSE 100 in the UK, specifically FTSE 250, FTSE Japan. These are basically indexes. So you've got Vanguard, which is a very big company, probably worldwide, that provides funds or ETFs that we're going to discuss in a bit to track these indexes, so to speak. Then there's iShares, which is a product from BlackRock. BlackRock is a parent company. iShares exclusively focuses on ETFs, so iShares is BlackRock's ETF arm, so to speak. But they obviously, BlackRock themselves would definitely offer funds that track the S&P 500 or the FTSE if you need to. Apart from that, you also got uh, SPDR. So SPY, which is the ticker, is one of the oldest ETFs in existence, which is basically tracking the S&P 500, and it's offered by a company called State Street Spider, SPDR Spider. And the relation between SPY and the S&P 500 is basically SPY trades at one tenth the value, or one tenth the proportion of the S&P index. So S&P index is at 3974 as of right now, and SPY I can almost guarantee you would be roughly one tenth in terms of US dollars. So this is in points, obviously, because it's an arbitrary number, whereas this is in dollars because you're trading in US dollars. So they'll just track the S&P at a 10 to 1 basis, so to speak. And ETFs, again, we're not going to talk about a broker yet. Don't worry about that. So, right, let's crack on with the meat around today's episode. Let's crack on. So we've already been through the disclaimers. Again, just trying to get my points across, the ideas across, so people are aware of what's out there for them. We're going to talk about funds today. We're going to talk about ETFs or exchange traded funds, as well as other investment funds available to you, which include but not limited to the mutual funds, index funds, and hedge funds, not in that particular order. And on Wednesday, we're going to talk about derivatives, which is an exciting new topic that I really want to put across, and why you shouldn't fear derivatives. And push across to actually diversify using a derivative. So that's on Wednesday, I believe. Don't worry about that yet. Right. So diversification. So let's assume it's back in Jan 2017. You're keen on investing in the automotive sector. I work in the automotive industry myself, and working in the industry, I have some sort of familiarity to it. So I feel safe investing in automotive companies, knowing that, oh, I think this company is going to do better than this company. We all knew Tesla's going to do better than the competition for a few years ahead, because they're so far ahead in their technological leaps. But other companies are now catching forwards. Anyways, let's assume it's Jan 2017. You've got these five companies to invest in, Fiat, Chrysler, Ferrari, Tesla, GM, and Ford. And if you're unlucky enough, you think Ford is going to do really well for the year of 2017, then tough luck for you. You're only going to average 4.8%, 5%, whereas the market, the S&P index would have done. I don't know what it's done, but I'm assuming it's roughly 7 to 11%, assuming the average over the past couple of years. So you'd be better off investing in a fund rather than a particular company. Whereas if you are fortunate enough to invest in Fiat Chrysler, you would have outperformed the market several times over. However, if you tell me today which company is going to do 50% better or 80% better from the point today, then you deserve a cookie for that. But oftentimes in real time, when you're making these decisions, it's significantly more challenging to get across, trying to understand what's happening out there. So you've got no clue where to start investing. So that's where funds or index funds come into play. Index funds try to get you the mean result of these. So what if you could invest in a fund or in a portfolio of all of these stocks in equal proportion, right? So one of five portions go to each of these stocks here. You would average roughly 47% as per my calculations, which is actually better than three of the five companies you can see here. So you'd be outperforming three of these five companies on the screen by just investing in all of them altogether. And if a few of them go a bit lower, you'd still be much better off investing in equally in all of them, so to speak. So that's index funds. As I've mentioned several times over, you can't invest directly in an index. They're merely a benchmark metric. However, if you copy an index's constituents into a single portfolio and sell it to the public, you've got index funds. Um, the index the most popular ones track the S&P 500, as I mentioned, but you've got the FTSE 100 in the UK and other variations of it across the world. And different providers compete together, compete against each other to track a similar index. They provide a fund. Each of them provide a fund that tracks the same index in terms of competition, so that they motivate you to put your money with them. That's their driving. That's their driving motive. The benefit for consumers is that the cost of these funds has dropped drastically due to competition in the market, going from several percentage points all the way to 0.0% in America, and dropping, I think, as well as you got 0.2% in the UK. I think that's one of the cheapest funds I could find that tracks the market, so to speak. I think, in my opinion, it's like the second best instrument to invest with. My personal choices don't matter, but it's just something I want to put across. Index funds could vary, even though they track the same index, simply because of the way they choose to track the index. So, if the S&P 500 says I will allocate 3% to Apple, 2% to Microsoft, 1% to Tesla, half a percent to Intel, and 0.3% to Nvidia, or however. Uh, an index fund provider can choose to copy the index per line, as in every single item in the index, or they can choose to eliminate random ones from similar sectors. So if it's only tech, they could choose to just get rid of Intel um, from the index, and they would have, the amount they were going to have for the tech industry divided amongst fewer constituents, right? And they could accidentally have bumped out a loser for the year. So if they bumped out Intel, for example, for the past 2 or 3 years, they would have actually outperformed an an index fund that does have Intel in their portfolio, just by pure chance, and nothing else. So the way they try to recreate the index within their fund does matter, and you could look up this information in the brochure available from the fund provider. So if they copy it line by line, exactly as it should be, then that would probably be called a physical replication. Whereas if they try to eliminate certain elements out to trim out, the issues they will have, or the requirement to manage multiple positions, they would call it an optimized or a synthetically optimized index, so to speak. Right. So if you remove the rule to follow an index from the fund, that becomes a mutual fund. This is just a very rough guideline. It's not exactly like this, but this pretty much sums it up for most common people. This is where investors mutually come together and agree to invest in a fund that's led by a manager, and the manager then proposes rules or ideas that they can run the fund with or by. So they have rules that they identify, or they highlight, and if you think that their ideas are solid and would probably do better than the index, that's when, that's the appeal towards mutual funds, as most of them try to beat the annual performance of an index fund by investing in emerging trends, or they may try to eliminate the weaker index constituents on purpose. A mutual fund might choose to eliminate Intel because of their weak performance recently, or may choose to involve Intel as they're staging a very strong comeback in the past coming weeks, so to speak. And God knows where Intel's going to be from now, but this is all in the manager's head. It's great if you fancy a bit more involvement with your investments, or have a certain bias that you wish to test. You might have a mutual fund that does exactly the opposite of what the market's doing, or may choose to intentionally eliminate sectors that you no longer want to be involved with. In which case, mutual funds could be the way for you to go. They don't follow any particular index, as I mentioned, so there's nothing to benchmark them against. You could just benchmark them against the S&P 500 as a base market, but that's not really fair, because the constituents, the performance would be wildly different at best. So if you take your index and your mutual funds, and you take out and you give them the ability to be traded in real time, that's what an exchange traded fund is, or an ETF, right? So index funds and mutual funds are largely becoming obsolete with the younger generations. They're never going to die out, because your pension, your if you invest in the blended items that companies provide, like the Vanguard Life Strategy, or some of the other iShare products out there, or even the target retirement fund that Vanguard offers. That's just examples that I know of at the top of my head. But if you invest in any of these kind of items, they reinvest your money again in other mutual or index funds, right? So therefore, money is never going to completely leave index or mutual funds. They will always be around. But because of exchange ETFs popularity growing in the market, and the competition from brokers in the US and increasingly in the UK, ETFs, or exchange traded funds, are becoming quite a lot more popular. As I mentioned, they are listed on the stock market, just as and behave, or are treated just like any other stock, which we'll discuss in a few minutes actually. They allow for funds to be traded in real time, so you know exactly the price you're paying. And I'm going to let you know why this matters in a few minutes again, but it does make quite a difference compared to index and mutual funds. And ETFs on general tend to have lower fees than their index or their mutual fund counterparts, and they're legally required to publish their constituents on a daily basis at the end of the market day. This is largely true. However, there are now ETFs coming out with special regulations that don't need to be disclosed daily, but that's a very minor aspect of the market, and not yet in the mainstream availability. And because ETFs are quite easy or relatively easier to get across to the public relative to index and mutual funds, the new emerging themes seem to be coming out at breakneck speed. You got a new ETF for tracking the esports sector altogether. The one of the famous ETFs for that is ESPO. If you look it up, it'll bring up some details. You've got ETFs that track the semiconductor industry. You've got ETFs that track companies which have a financial moat, i.e., an advantage, such as Coca-Cola and other similar companies. So, coming up with ideas or themes to invest in is much easier to publish or to give out to the public than with index or mutual funds. Right. So, this table actually summarizes some very important points between funds and ETFs. By funds, I mean index and mutual. So, funds do not require a brokerage account. So, having a brokerage account or having the ability to provide brokerage accounts from a broker's point of view requires additional legal loopholes or something that they need to get through. Loopholes is the incorrect word, but they require some framework that needs to be put in place, which is why there are such few brokers relative to companies that provide funds. Banks provide funds nowadays. You've got HSBC and NatWest, two companies I know for sure, two banks I know for sure, which offer their own version of funds in their invest section of the bank. Of course, they've got certain legal frameworks in place, but not enough to sell stocks, or they're super expensive to sell stocks or buy stocks in, rather. So ETFs do require a brokerage account, and they're treated just as a stock, whereas funds do not require to be treated as a stock. And and that's why they used to be slightly more famous, because back in the day, buying and selling shares used to incur like a 11 or a 15 pound charge to buy and or sell, which is both ways, to be honest. Whereas funds didn't incur such high charges, which is why funds became so famous in the first place. Additionally, funds can be bought in fixed dollar amounts. You can allocate, like, I want to buy $100 worth every month, and the fund provider like Vanguard or BlackRock could actually set up a direct debit directly with your account, as a legal framework is already in place to do so. Whereas ETFs can only be bought as integer shares, like one, two, three, 4 units, not like you can't buy half or quarter or so on and so forth. And hence, just like stocks, you can't set up automatic investments. The reason I put an asterisk there is because there are brokers coming out now which provide the ability to buy fractional shares. Like Trading 212, you can actually buy a quarter share or half a share of Apple or a quarter share of Tesla and so on and so forth. Consequently, you can also buy quarter or fractional shares of ETFs. Therefore, they're now equally competitive in terms of being able to buy ETFs or funds with a fixed dollar or a pound amount. And with companies like Trading 212, you can also set automatic investments set up. But with Trading 212 right now, you can only do it with debit or credit card, which incurs a very small fee, as opposed to direct debits with funds, which don't incur any fees from the bank's perspective, or the broker's perspective, so to speak. Whereas funds typically, as I said, do not incur a fee anymore. They're basically free to buy and sell. They do have a management fee, which we'll talk about later. Whereas ETFs, as I mentioned, most brokers still charge a fee to trade shares and stocks. Therefore, charge a fee to buy and sell ETFs. There are very few brokers out there who have 100% commission free trading, so to speak. Examples come to mind. There are Trading 212 or Free Trade in the UK. As you can see, 2 out of like 50 or something. Whereas something like Vanguard, I'm sorry, Vanguard even, or HL, has Cleveland Lansdowne, or AJ Bell, they charge like 4, 5, 11 pounds per purchase of share, so to speak. In America, the competition is much more fierce. You've got Webull, and you've got Robinhood, and you've got M1 Finance, I think, that allow you to buy ETFs or shares at no commission, so to speak, which is why they're becoming increasingly famous. They're both available as themes or to address niche markets. So I would say ETFs are a bit more modern. So they do involve some modern themes, as opposed to just whatever funds are available. ETFs are easier to release to the market. Hence, you'll see a lot more themes in them available. Right, this is one of the most critical points wherein funds are priced and traded in a batch. So the funds are priced only once a day, and this cutoff time is set by the provider. It could be 12, 1, 3 p.m., 1 p.m., just after market close. So, 4:30 p.m. UK or whatever. It depends on whatever they provide, whatever the fund provider decides. And they also set a separate cutoff time before which you would have had to paid your purchase for. So if you purchase it on day one before the cutoff time, it's likely that you will own the shares on day two when they're traded, but you don't know what the price is going to be because they're only priced once a day. If the market goes up 10%, you will then own 10% less shares than you were expecting to with the same number on the day previous. Or if the market falls 10%, you would accidentally have got 10% more shares than you were expecting to than the day before. So, and if you do it after the market, after the cutoff time on day one, you would have missed the deadline for your order to have gone through on day two, and consequently, you would have actually owned the fund on day three by the time they actually do the trades in. And in those 2.5 days, again, you're completely at the mercy of the volatility of the fund that you're investing in. Whereas ETFs are traded and priced in real time. So the price is the price and the price that the ETF is worth and the price you pay for are two different things. Funds and ETFs, what they're worth is often called the net asset value, which is the sum of all their assets or sum of all their constituents divided by the number of available shares, right? That's a simple math equation there. That's the net asset value. However, because ETFs are traded just like any other stock, and stocks are and ETFs are, susceptible to speculation and things like that, the ETF could actually be trading for a higher or a lower price than its actual worth. So if you buy it for less than what it's worth, you've actually got a few pennies in discount. Or if you buy more, you've actually overpaid for the constituents. So you'd be better off, doing the portfolio allocation yourself. However, because the market is so efficient, the variance would be a couple of pennies at most. So funds typically tend to have a higher management fee and a purchase fee in some cases. And because of something called cash drag, which is their legal requirement to hold cash within the fund, they actually tend to underperform ETFs, which are typically cheaper to manage, run, and operate, and are also considered more tax efficient for US investors specifically. I think in the UK, it doesn't make a difference, sadly, but the US do benefit from ETFs being much more tax advantaged, hence their popularity. Um, yeah, and basically because of the ETF's ability to, trade and get in and out of positions relatively quickly, and the way they operate, the framework that goes behind them, which is completely different to funds, they tend to outperform the funds which track the same index. So if I got a fund and ETF tracking the exact same index, and the fund and the ETF both have the exact same costs the exact same cost to the consumer, I can almost guarantee that the ETFs would outperform the funds simply because I think the costs incurred by the provider would be much less than funds themselves. Funds also are often very opaque. The holdings of a fund can be issued at a time that's suitable to the provider. Of course, there is a maximum. There's a legal maximum as provided by the government or the financial regulation authority of the country. In some cases, funds could only issue their constituents quarterly, which is 4 times a year, and even by then, when you see their document, it could already be outdated. So they could have done their they could have changed positions without you knowing what's happening in there. Whereas ETFs actually are legally required to publish their constituents on a daily basis after each trading day. So, one of the famous ETFs coming out there, ARK. ARK is a company in America that issues ETFs, not indexes, that track various sectors that they think will boom in the future. So, ARKK is their innovation fund. ARKF is their fintech fund. ARKG is their genomics fund. ARKX is their upcoming space fund, exchange traded fund ETF. And you can actually see what the constituents of each of these ETFs are and recreate them in your portfolio. ARC funds aren't available to trade for UK investors or even EU investors because of legal framework. However, you can look at what ARC G, for example, is doing on a daily basis, and you can readjust your own portfolio. So you can buy all the stocks within ARC G in the exact same percentage because that data is publicly available, and recreate the fund in your own account, just not having it under the ARC G name. So you would have 50 or 100 positions as opposed to one, which is ARC G. Right. So, looking at the entire GameStop saga, I thought it'd be best to talk about hedge funds as well. So, ultra rich people don't actually invest in index funds or stuff like that. They've got people who they hire and run their assets or manage their assets for them. So and these people, and they also invest in bespoke products that are available specifically to high net worth individuals who have a large initial capital to invest, a couple of £100,000, couple of million quid, and of course have to pay an ongoing fee which is significantly higher than index or mutual funds, to cover the bespoke features they're obtaining from their provider, or their broker, or their fund, so to speak. Hedge funds, however, have access to instruments and strategies not available to most people. So, one of the most famous ones is Michael Burry's hedge fund, Scion Capital, I believe it's called. So, if you again referencing the Big Short, he used swaps, or swaps are a form of derivative which we'll discuss on Wednesday. But I know Michael Burry recently also dabbles in options, and he may even get involved in CFDs for all we know. However, it's very unlikely because CFDs are unavailable in the US, so he's not going to get involved in them. However, they've got instruments and strategies available to them which are not easily accessible for common folk. I mean, granted, CFDs are easier for British residents, so to speak, but options and swaps are significantly more challenging to obtain or access. So it's not worth considering hedge funds unless you've got like a couple of hundred grand, or a couple of million even, to begin investing with them, to get a bespoke portfolio made for yourself based on what your manager or the person you're trusting with, the money with, thinks the market's going to do. Yeah, and thank you for dealing with this 31 minutes. For the second time for some of you, actually. But I'd like to wrap up with Warren Buffett, what he said. It's you got to know what you own. You got to look at the constituents of your funds, because your pensions, your savings, your ISAs all rely on what's in them, and you got to know why you own them. There's no point just saying, "Oh, I'm going to throw my money at the market and see what happens." You got to have some goals going forwards, and if you don't want to invest in companies that deal with energy, for example, fuels, or non-renewable fuels, for example, or ammunition, or what's the other one, alcohol, or tobacco. You can always find funds that don't invest in these companies, and they're quite easily labeled as ESG funds, environmental, social, governance funds. So you got trading Track Insight, which is actually a very good resource for such work. I would definitely recommend looking into them. Of course, Yahoo Finance, which we looked at yesterday. Morningstar is also a very good way of finding funds. Morningstar doesn't do ETFs very well. I think Track Insight does ETFs and funds. Yeah, and then yeah, just feel free to look at Finwiz and TradingView. They too would also include ETFs within them, but not funds, because they look at whatever's on the exchange, but not what's available outside exchanges, i.e., funds. And I think that's about it. The next episode is going to be derivatives on Wednesday, so feel free to join in same time, 8 p.m. on Wednesday. And thank you once again for your time. Cheers. If you got any questions, feel free to message me on social or any mean. And yeah, thank you for your time.